Yeah, it's too much passing around.
Yeah.
Back here.
Good afternoon, everyone, and thanks for joining us today. My name is Harsha Sekar. I'm a shareholder here at Pulcinelli. On behalf of my client, the Centennial State Liquid Investment Pool, or CSLIP, it's my pleasure to welcome you to today's event. We're truly honored to bring together such a distinguished group of experts in the field of public funds investment management. The state's newest LGIP, or a local government investment pool trust fund, CSLIP offers a critical cash management resource for governments across Colorado. The fund's mission entails three primary objectives: protect capital, preserve liquidity, and maximize yield. The fund has a AAA rating from Standard & Poor's, which is the highest rating assigned to money market funds by S&P, and is limited to entities that reflect, quote, an extremely strong capacity to maintain principal stability and to limit exposure to principal losses due to credit risk. CSLIP's commitment to transparency, integrity, and serving the best interests of communities across the state has made it a trusted partner for local governments seeking to manage their finances effectively. During this event, our experts will discuss the evolving landscape of public funds investing, political and macroeconomic trends, and the opportunities and challenges that lie ahead. A few words on Pulcinelli. We are a national law firm known for our deep expertise in investment funds, private credit, and public finance, among many other areas. Our firm provides comprehensive legal services to clients navigating the complexities of the financial markets, and we routinely work with investment managers, issuers, and governmental entities to address regulatory challenges, manage risk, and raise capital. We're grateful to our panelists for making the event possible, and we look forward to an informative discussion. And with that, let me hand it over to Ben. No? Carter.
Thanks, Harsha. I really appreciate that. My name is Carter Bullion. I am the Vice Chair of the Board of Trustees for CSLIP. Just wanted to take an opportunity just to say thank you to all of our audience members, both here physically and virtually, but really a big thank you to our panelists. I'm actually really looking forward to today's discussion. You know, I would be remiss if I didn't also thank all of our great partners, our administrator in Mendenhall, you know, putting this event on for us, as well as Harsha Sekar, General Counsel, and Pulcinelli for offering this meeting space. So again, just really want to say thank you to everybody for being here. You know, this is a great opportunity for us to learn together and to network. And without further ado, give it over to Ben.
Thank you, Carter. Good afternoon, everybody. Ben Mendenhall. I'm the administrator for the Centennial State Liquid Investment Pool. I've been assisting local governments here in the state for 18 years, playing for most of the teams that you've all heard of. It's an honor to be up here in front of everybody today. I wanted to just thank the Board of Trustees for giving me the opportunity to serve the taxpayers of Colorado at a high level by offering a diversification option as well as another liquid investment pool here in the state. I think we're long overdue. So with that, I'm going to introduce our esteemed panel up here. We're really excited to go through our presentation today and have a nice conversation. And first and foremost is we have our portfolio strategist from State Street Global Advisors here, Will Goldthwait. Will is a vice president at State Street Global Advisors. He's a member of the Global Cash and Global Fixed Income Investment teams. Will is responsible for communication of cash and fixed income investment strategy, performance to clients, consultants, and prospects. He covers multiple sectors and vehicles, including both active and index fixed income. Will has a very long bio in fixed income. So it's an honor to introduce him. And next we have Jim Eek from the state of Colorado, who's the debt manager of the Treasury with over a decade of public service, financial experience, and he specializes in public finance and treasury operations for the state and finds it incredibly motivating being a financial advocate for the people of Colorado. Professionally, James started his financial services career in a local credit union, working his way up the ranks from a teller and becoming a member, service representative, and loan officer. He started his treasury operations experience at a biomedical firm in Lakewood, eventually moving on to become the treasury and finance manager of Thompson Creek Metals. James began his public service career at Denver Public Schools as a senior manager of treasury in 2014. Personally, James loves spending his time enjoying the wonderful natural resources that Colorado has to offer with his friends and family. Next, we have Michael Persicchetti from RBC Capital Markets, who oversees the Colorado Public Finance Office and is the #1 underwriter of municipal bonds in the state of Colorado. Since 2001, 2021, he has underwritten 6.5 billion in bonds for Colorado clients, which is nearly 3 billion more than the closest competitor. Michael is responsible for providing comprehensive investment banking services, including the transaction execution and quantitative structuring of both tax-exempt and taxable debt financing for Colorado clients. Up next, we have Mr. Stephen Abbey from Huntington Bank, who serves as the custodian for CSLIP. Steve is the leader of our institutional government and nonprofit banking group, which offers deposit credit, transaction processing, capital market services across 9 Midwestern states and beyond. He and his team of FINRA licensed professionals develops and cultivates banking relationships with larger public sector clients, including colleges and universities. Steve has 30 plus years of banking experience based in Chicago, covering the government, nonprofit, and healthcare sectors. Okay. Right. Well, here we go. So we're going to ask each panelist a series of questions, and we're going to go in kind of a different order than usual, but we're going to start today with Mr. Eek from the state of Colorado. So Jim, under Colorado issuances, Colorado is unique because of TABOR restrictions regarding financing. What market concerns do you see in the coming year, and does this affect your decisions?
So that's a great question. I know everybody in this room really enjoys the TABOR refunds we get, but it really makes a big problem for the financing for the state of Colorado. You guys hear me? Because I project my voice more than. So with that, the issue with TABOR becomes we can't issue just general obligation bonds like all other states can. So if there's ever an emergency or we need something done during a crisis, or just hey, something happens, we need to repair a building, those type of things, we don't have the opportunity to do those things with TABOR. The way we can do financing is a piece of legislation has to be passed in order for me to move forward and actually do any type of financing for the state of Colorado. So because of TABOR, it adds layers of complication. It does impact our ability to actually get credit, and our credit rating is one notch below the best. And it's really because of TABOR. So it costs us more money in the long run. It also, because we can only do COPs effectively, we had add costs to the front end of borrowing. So TABOR in general, like I said, really awesome for the refunds, terrible for financing for the state.
Okay. Next question is for Mr. Goldthwait. Has the election outcome increased or decreased the chance of a soft landing? Second part of that question is there now a chance of no soft landing?
Meaning no landing. Not a hard landing. Yeah, no, it's been fascinating. Really, this Republican majority and this pro-business and anti-regulation stance that is being well projected, starting with the Doge group, is going to be really interesting how that affects economic outcomes. One thing that we do know and we are projecting is that the Fed will move at a slower pace based on the information we have right now. I think I pause when I say that because one of the indicators that we've been looking at is Fed fund futures, and that's a gauge of where the market is at any point, and it does the whole curve out to 2 years. I just look at the 10th contract as sort of an indication of where we're going to be on a relative. I mean, you can't really look out 2 years, but sort of a year out is, we think, a reasonable level to look at. That contract has whipped around by 100 basis point increments over the last couple of years, indicating that there really is no sort of set path. So I think the thing that I would emphasize to this group is be very careful if you're trying to make forecasts, because forecasting is particularly difficult right now. So our forecast is that the Fed will ease by 25 basis points in December. We think the closer we get to that date, the more likely it is. And then probably on a quarterly basis next year, but really I only feel comfortable in the first half of the year, and that's 50 more basis points. I think if we end up down in the low threes in a year or 18 months time, that's probably reasonable, because there's so many secular forces that are at play here. One in particular is demographics. We've got a huge segment of the population that is all but retired, the boomers. We've got sort of a Gen X group, including myself, that's sort of a smaller demographic in the middle here. And then we've got the millennials that are sort of building, trying to create those households. So that impact and what that has on the economy is really going to be uncertain. Additionally, tariffs are something that's going to be really interesting to watch how they play out. And the thing I really want to emphasize on tariffs, and we've written a paper on this, and I'm happy to share that with you, is tariffs are a one-time cost increase. And I think people are super sensitive to inflation now. It's fair to say that the Dems lost the election because of that, or as the acronym goes, milk, eggs, and gas. MEGS has been the thing that really tipped the scales, I think. People are very frustrated with that. But with a tariff, that increase is a one-time increase. So if the administration taxes China another 40% up to 60% on any goods imported from China, that's a one-time cost increase. It doesn't mean that that's going to go up by that increment every year. So businesses will adjust. So with that said, it's just really uncertain what sort of longer term effect those tariffs have on the economy. And that's why we're just uncertain on what the second half of 2025 looks like.
Well, can I ask a question?
Yeah.
There's also been, from what I've heard, some talk about potential rate hikes sometime in the future. Can you talk about what might affect that?
Yeah, the rate hikes, that's a very interesting one, and something that is getting, particularly with back-end rates, 10s and bonds, 10s and 30 years, moving higher or not moving down as much, the curve steepening, as they say. The thinking there is that if there's so much pro-growth, stimulus, tax cuts, pro-business, deregulation, let's go, that could mean higher wages. It could mean accelerated economies. That means that the Fed might say, whoa, we need to slow this down. Otherwise, we're going to have another surge in inflation. Therefore, we might not be cutting rates. We might be actually moving rates higher. And I think it's a great question, because it's not our base case right now, but I think it adds to the uncertainty in the second half of this year. A couple things working for that is like the immigration policy or a deportation that could create significant stresses on the labor force, which could then cause people to get back into sort of a 2021 scenario where you're really desperate to hire people. You can't find labor force, particularly at the hourly wage sector. And so therefore those wages go up. One thing we have observed, if the hourly wage worker is getting paid more, they're spending it straight away. So those folks tend to be most at the margin, and therefore any additional dollar that comes into their pocket goes into the economy, rather than at the higher wage levels, those tend to go into savings. And so that's very inflationary.
All right, thank you for the question, and right back to you, Mr. Persicchetti. What has occurred in the municipal market post-November election? Voter approvals, urban versus rural, and what perspective do you have there?
Yeah, so that's interesting. So this year was a presidential election, if everyone knows, which always kind of brings out everyone going to the ballot, right? Everyone wants to have their debt questions, their tax increase questions. Voter turnout is typically higher. And we saw that the case in Colorado as well. We did not see cities, for the most part, come out with debt questions, but we did see a lot of cities come out with sales tax increases, lodging tax increases, de-Brucing questions, that kind of thing. And generally speaking, I think CML said that there were only 4 debt questions that were done by cities. Most of the debt was actually done by school districts. So school districts in Colorado were somewhere around $6.6 billion on the ballot. It's the largest single year in Colorado that we've ever seen. And generally looking at it, there was a large divide between school districts that were rural and school districts that were urban. The biggest differential between those two is the way that they were asking their question. So when we saw issuers asking the question that had a tax increase, they generally were not successful. If they were not increasing the tax rate, they were generally successful. So we saw that in Aurora, Denver Public Schools, St. Vrain Public Schools, a lot of the large urban areas, whereas the rural areas did not necessarily benefit from that aspect of not being able to say that you don't have to increase taxes for this. On the city side, in terms of just general taxes, it generally followed what happened in 2020. There were less questions this year than there were in the prior 2020 election, but the results were very similar. And what we ended up seeing in terms of interest rates in our marketplace for those who were trying to get into the market post-election is that there was a large spike in interest rates. So generally bond issues in Colorado are 20 to 30-year bonds if you're on a new issue basis. And as the long end of the yield curve has gotten steeper on us, the cost of borrowing has gone up. Now, the last 2 weeks or so, we've seen a reversal of that. So interest rates have started to tick down, volatility has come out of the marketplace, and issuers are trying to issue by the end of the year. So in Colorado, we've got a big slate of bond issues, both this week and next week, from a lot of these issuers. So this past week was close to $1 billion in Colorado, and next week will be close to $1 billion in Colorado as well. City of Aurora will be pricing on Tuesday. And what we're seeing is that these issues are getting bigger and bigger. So where you saw a lot of 10, 20, $30 million issues in Colorado, we're now upwards of $100 million plus in our bond issues. So it is getting more and more expensive to build, and the voters are starting to get used to that in the urban markets, but not necessarily in the rural markets in terms of understanding that cost differential. So we have seen it be a big issuance year. It'll probably be close to or surpass 10 billion in Colorado, which is generally a fairly normal issuance year. Next year, we think it'll probably be an even bigger year, just because of these bond elections that have occurred.
That's a follow-up question. Our market's pretty favorable. Is this supply getting absorbed pretty easily?
Yeah, I'll give a real world example. So we priced a little over $300 million worth of bonds for Cherry Creek School District earlier this week. They got $4.5 billion worth of orders for those bonds. So the market still has a lot of cash. What has happened is we've had 22 weeks of inflows into the municipal marketplace. And when I say inflows, traditional municipal buyers are muni bond funds, right? So Franklin, Fidelity, Nuveen, the kind of household name Vanguard that you've heard over the years. And we've seen investors come back over the second half of the year. And so they have a lot of cash. And then in Colorado, you have December redemption. So typically we have June and December payments. And so when you have December payments for investors, they have cash that they now need to reinvest. So you have a lot of money that's out there and a lot of new issuance in Colorado that we haven't seen over the first half of the year. So it has been very good in the marketplace.
Excellent. Thank you. Mr. Abbey.
Hi.
Hello. What is the state of the banking landscape today?
Let me start by saying, as a flatlander, I'm glad you guys have your backs to it. I've got this view in front of me of the mountains, which is just gorgeous and spectacular. I can't believe you get to see it every day. I'm envious of that. But banking landscape. Earlier question about hard landing, soft landing, no landing, and all that. Interest rate becoming more normal, upward sloping. Those are all good things for banks. Because banks generally borrow money from you all in the government space as deposits, and then lend it out to companies and businesses and individuals who buy stuff or make stuff. And typically, we do better when the longer rates are higher than the shorter rates. We're paying deposits at the short rate, and we tend to lend it out a little bit longer. It's been a struggle the past several years when the short rates were higher than the longer rates, right? The dreaded inverted yield curve. By the way, Doctor, you'll have to explain why we didn't get a recession for 2 years of an inverted yield curve. I'm an economist degree. I just want to know. Banking is good because the credit losses have been managed low, despite the headwinds, despite the return to work problem, which I don't know if you guys in your government space have trouble getting your employees come back into the office. We in the bank are starting to mandate it. I know what we just talked about. And it hurts the local businesses around your offices who don't get people going out to lunch or going out for drinks or going to a play. And so, we do think that this is a good moment. We haven't had the credit losses. The capital reserves, therefore, are good. There's still a lot of cash in the system, both in banks as well as in places like CSLIP. And that's because we have been in and are only now starting to exit a period of time when liquidity is dear. You guys know that who are invested in CSLIP and others. You're getting paid 5%. It used to be 50 basis points. It's liquidity. If you've got it, it's valuable. If you need it, it's costly. Starting to change a little bit. See how fast, according to what you just heard, it might not go as fast. But for the banks, it looks to be a good moment. The credit losses are contained. The cost of the deposits are coming down. The loan demand, with people becoming more confident with a soft landing, is picking up. So it's a good moment. And I think there's been some separation. I just think for myself about the spring of 23, when everyone thought the world was going to fall apart, when Silicon Valley Bank collapsed and Signature Bank right behind it and others. And, that was a bad moment because inverted yield curve and rates were still rising at that time. And that's a tough moment for banks generally because your cost of liquidity is going up. You can't change your loan price that quickly. So it's fine. They went out, but nobody got badly hurt. And other banks like ours and others need to move against that to them. And now we're in a different. It's a good moment for the banking landscape, and including and especially regional banks that should benefit even more with those factors I just mentioned.
Thank you. Now, a CSLIP question for Mr. Goldthwait. Within CSLIP, have you changed the strategy based on the election or any other events? And are there any stresses starting to emerge in the short-term market?
Yeah, it's a great question because we've gotten that a lot from clients, particularly the inflation question. And like, oh, wait a second, are we going to start to see perhaps the Fed turning and either holding rates or even raising rates? And based on the data that we're looking at and based on sort of how we look at the market from a structural, cyclical, and tactical standpoint, we still feel that the Fed is very much biased towards bringing rates lower. And even if we saw an acceleration in growth, we just feel as though they're still biased to get rates closer to whatever neutral is. And we don't know what neutral is, but it's probably not 4.5. So within the portfolio, we had been buying a lot of duration. We've been trying to get money out the curve, trying to maintain those yields for you guys while the Fed is lowering rates. But at the same time, we also recognize there is a little bit of risk to the Fed holding on a little bit longer or moving a little bit more slowly. So we have been layering in floating positions. So right now our duration is sort of neutral to slightly long. We have it, with a 60-day max, we have it somewhere around 40-ish days, less plus, really depends on cash flows.